Hello, welcome to SuccessTrack TV. I'm TJ, and I'm so happy that you found my channel. Today, let's talk about what happens when the Federal Reserve, also known as the Fed, adjusts interest rates. But before we begin and get into this video, make sure to hit the subscribe button and the bell icon to get notified of our new videos. Then leave a comment below this video saying I've subscribed. I'll try my best to reply to as many comments as possible. Let's jump right into it. The Federal Reserve is the nation's monetary policy authority. It sets interest rates and influences the availability and cost of credit. The Fed's goal is to stabilize prices and promote a healthy economy. In the past, the Federal Reserve has used a wide range of tools to accomplish its goals. This included lowering the federal funds rate to near zero and intervening in the corporate and municipal debt markets. These tools helped the economy recover from a deep recession. However, the Fed's interpretation of maximum employment has changed over time. In recent years, the Fed has focused on shortfalls in employment below the maximum level. Unlike fiscal policy, monetary policy is designed to stimulate economic growth. By reducing interest rates, the Fed encourages spending and borrowing. Businesses and consumers can then spend more money. Lowering rates also increase inflationary pressure. During the financial crisis of 2007-09, the Fed intervened in the bond and mortgage-backed securities markets. It purchased huge amounts of treasuries and assets to help keep the financial system functioning. So the Federal Reserve's interest rate decisions really have important effects on the economy. It determines how much banks pay for borrowing overnight and sets the benchmark for the other short-term rates. These decisions also influence the amount of money that consumers and businesses spend. Lower interest rates promote consumer and business spending by lowering the cost of borrowing. This allows businesses to expand or hire more workers. High interest rates discourage borrowing, making big-ticket purchases more expensive. Rising interest rates also reduce the net worth of businesses and individuals. As a result, the stock market and the bond market suffer. When the Fed raises interest rates, the supply of money in the financial system falls, reducing the demand for credit. This lowers inflation and reduces exports. Because of this, the government's budget would be less robust if interest rates rise. On the other hand, higher interest rates also have a silver lining for savers. Despite fears of inflation, the Fed has kept interest rates near zero since the Great Recession. If you want to keep your money out of debt, saving cash is an excellent idea. This will allow you to easily access your funds when you need them. It can also act as a buffer against stocks, which might fall in value when interest rates rise. Savings account rates are generally based on the federal funds rate, which is a charge that banks pay for overnight lending. The Federal Reserve, which plays a central role in the U.S. economy, sets this benchmark interest rate. As the Fed raises its rate, the savings account yields become more favorable. Some savers may see their annual percentage yield or APY double or triple. Higher yields are often offered by credit unions and local banks. However, they won't give you as high of a return as a certificate of deposit or stock investment. There is a lot of discussion about the Federal Reserve's recent interest rate hikes. But the question remains, what are the effects on the economy? When the Fed raises rates, it reduces the amount of money in the economy. In turn, this reduces the demands for goods and services and decreases the overall size of the economy. One of the ways in which the Fed has attempted to counteract the effects of increased rates is by buying large amounts of government and mortgage-backed securities. These purchases have had a big impact on the bond market and on consumer spending. The best way to counteract the effects of higher rates is to diversify your portfolio. This is especially true of bonds, as the yields on bonds will rise with the Fed's rate hikes. To mitigate the risks of losing your shirt, it may be in your best interest to consider investments in safe havens, such as gold, silver, and oil. So there you have it. That's what happens when the Federal Reserve adjusts interest rates. One last thing before you leave. If you liked this video and found it helpful, make sure to hit the subscribe button and the bell icon to get notified of our new videos. Then leave a comment below to share your thoughts, and I'll do my best to reply to as many comments as I can. Also, make sure to watch the next video that's coming up. Thanks for visiting SuccessTrack TV.